Are you a daily wage person who wants to attain financial freedom via the stock market? Do you want to invest but often feel confused about the concept of investing? Are you looking at the stock market as a potential income source? If yes, then this video is going to be the perfect place for you, so make sure to watch until the end. In today's video, we will explain to you the world of stocks. Welcome to Money Mindset, the channel that gives you valuable content on making money and generating passive income. Be sure to subscribe and enable all notifications so you won't miss out on the weekly videos and grow your money mindset. First of all, let's see what is meant by stocks. Well, stocks represent ownership in a publicly traded company. They are the most effective way for the average person to build wealth over their lifetime. The majority of everyday people are salary earners. This means that one of the more attractive ways for the majority of people to expand their wealth is through investing. Because stocks are attainable and liquid, it is a way for investors to ripen their wealth over time. Hence, when you buy a company's stock, you become part owner of that company. For example, if a company has 200,000 shares and you buy 2,000 of them, you occupy 1% of it. Owning stocks enables you to earn more from the company's growth and gives you shareholder voting rights. Continuing with the benefits of stocks, you can see there are many potential benefits of owning stocks or shares in a company, such as a privilege on assets. A shareholder has a claim on the assets of a company it has stock. However, the claims on assets are applicable only when the company faces liquidation. In that event, all of the company's assets and liabilities are tallied, and after all creditors are paid, the shareholders can declare what is left. This is the reason that stock investments are assumed higher risk than debt, because creditors are paid before equity holders, and if there are no assets left after the debt is paid, the equity holders may receive nothing. Investing in stocks just means buying tiny shares of ownership in a public company. Those small shares are known as the company's stock, and by investing in them, you're hoping the company grows and performs well over time. If that happens, your shares may become more valuable, and other investors may be willing to buy them from you for more than you paid for them. That means you could earn a profit if you decide to sell them. One of the best ways for beginners to get started investing in the stock market is to put money in an online investment account, which can then be used to invest in shares of stock or stock mutual funds. With many brokerage accounts, you can start investing for the price of a single share. There are several ways to approach stock investing. Choose the option that best represents how you want to invest and how hands-on you'd like to be in picking and choosing the stocks you invest in. Generally speaking, to invest in stocks, you need an investment account. For the hands-on types, this usually means a brokerage account. For those who would like a little help, opening an account through a robo-advisor is a sensible option. An important point, both brokers and robo-advisors allow you to open an account with very little money. Going the DIY route? Don't worry, stock investing doesn't have to be complicated. For most people, stock market investing means choosing among these two investment types: stock mutual funds or exchange-traded funds. Mutual funds let you purchase small pieces of many different stocks in a single transaction. Index funds and ETFs are a kind of mutual fund that tracks an index. For example, a Standard & Poor's 500 fund replicates that index by buying the stock of the companies in it. When you invest in a fund, you also own small pieces of each of those companies. You can put several funds together to build a diversified portfolio. Note that stock mutual funds are also sometimes called equity mutual funds. If you're after a specific company, you can buy a single share or a few shares as a way to dip your toe into the stock trading waters. These are individual stocks. Building a diversified portfolio out of many individual stocks is possible, but it takes a significant investment. The upside of stock mutual funds is that they are inherently diversified, which lessens your risk. For the majority of investors, particularly those who are investing their retirement savings, a portfolio comprised mostly of mutual funds is a clear choice, but mutual funds are unlikely to rise in a meteoric fashion as some individual stocks might. The upside of individual stocks is that a wise pick can pay off handsomely, but the odds that any individual stock will make you rich are exceedingly slim. The amount of money you need to buy an individual stock depends on how expensive the shares are. If you want mutual funds and have a small budget, an exchange-traded fund. How much money should I invest in stocks? If you're investing through funds, have I mentioned this is the preference of most financial advisors? You can allocate a fairly large portion of your portfolio towards stock funds, especially if you have a long time horizon. A 30-year-old investing for retirement might have 80% of his or her portfolio in stock funds. The rest would be in bond funds. Individual stocks are another story. A general rule of thumb is to keep these to a small portion of your investment portfolio. Stock market investments have proven to be one of the best ways to grow long-term wealth. Over several decades, the average stock market return is about 10% per year. However, remember that's just an average across the entire market. Some years will be up, some down, and individual stocks themselves will vary in their returns. But for long-term investors, the stock market is a good investment no matter what's happening day to day or year to year. It's that long-term average they're looking for. Stock investing is filled with intricate strategies and approaches, yet some of the most successful investors have done little more than stick with stock market basics. That generally means using funds for the bulk of your portfolio. Warren Buffett has famously said a low-cost S&P 500 index fund is the best investment most Americans can make, and choosing individual stocks only if you believe in the company's potential for long-term growth. Last but not least, you must manage your stock portfolio. While fretting over daily fluctuations won't do much for your portfolio's health, or your own, there will of course be times when you'll need to check in on your stocks or other investments. If you follow the steps to buy mutual funds and individual stocks over time, you'll want to revisit your portfolio a few times a year to make sure it's still in line with your investment goals. A few things to consider. If you're approaching retirement, you may want to move some of your stock investments over to more conservative fixed income investments. If your portfolio is too heavily weighted in one sector or industry, consider buying stocks or funds in a different sector to build more diversification. Finally, pay attention to geographic diversification too. Vanguard recommends international stocks make up as much as 40% of the stocks in your portfolio. You can purchase international stock mutual funds to get this exposure. A stockholder may also receive earnings, which are paid in the form of revenues. The company can decide the number of dividends to be paid in one period, or it can decide to retain all of the earnings to expand the business further. Aside from dividends, the stockholder can also enjoy property gains from stock price appreciation. Well, as they say, nothing's all good and nothing's all bad. Certain risks come along with the mentioned benefits of investing in stocks. And if you are ready to take a little risk, then the stock market can be a way to your financial freedom. There is uncertainty for sure, but beyond the fear of failure exists the real possibilities. Well guys, that was today's video. Many thanks for watching. Let us know how you liked it in the comments section below. Also, make sure to subscribe, enable notifications, and stay tuned as we bring you more money mindset content. Hope to see you next time.